Good morning, ladies and gentlemen. Well, the risk dial is firmly stuck at 89, and nothing much happened this week. We basically closed where we opened and just faffed around. But the score keeps on being at 89, and all the spreads are saying that at some stage we get one final, probably push quite a bit higher. In risk, there is absolutely no reason not to suspect that we will have a final move that takes us somewhere close to 4,000 in the first quarter of 2021. And I will take this opportunity to actually review what happened during this year and what is likely to happen in the early part of next year, because I think the early part of next year is going to be the opposite of what happens for the rest of the year. Needless to say, the weeklies and the monthlies, when we close them in a few days' time, are going to be firmly pushing higher, which to me indicates that we have quite a bit of time left in this risk-on period. If we have a look at deviations, there is not a single chart that is anywhere near the red. All the middle lines are coming up strongly, indicating that any dip is going to be a nice buy. Whatever sector we look at, not a single one is overbought. In fact, the only utilities are showing you some moderate buy signals. Everything else is nicely in trend, exactly as you would expect. And this is not how trends end. Trends end with a strong uptrend, with people getting long at ridiculous and stupid levels. We are nowhere near that. Whatever sector we look at, everything is fairly in the middle, as it were. IWM might be the only one that's getting slightly ahead of itself, but that's a different story, and you know what I plan to do there. But everything else you can look at, including EEM, is just going sideways. Has done nothing for the best part of 2 months now, and is probably ready for maybe a faint down and then a spike higher. Absolutely no reversal of trend signal that one can come. The bond markets are indicating absolutely nothing at the moment, including the yield curve. We're still stuck in this 75 to 87, 88 area in the 2s, 10s. Germany is basically saying that it's going nowhere. I would have thought the five-year bubble is going to attempt to break this 68, 69 region, minus 68, minus 69, probably exceeded by a little bit and come back to it. The Bunds, exactly the same thing, creating some sort of a bull flag in yields here. And I think that probably has some more potential towards the minus 39, minus 40 area. But as we can see in the chart of the differential, we are failing badly at this 153 level. And I would not be surprised to see a move slightly lower down towards this 140 level over the next few days. But it's all marginal. There is absolutely nothing indicating that the bond markets are predicting any kind of change in trend for assets. The overall steepening trend of the yield curve in the States is absolutely undeniable. If we have a look at 5s, 10s, you can see how much that is continuing to steepen. Will he get to minus 73 basis points at some stage? Most probably. And that will most probably happen when we are around this 140 area in the 5s, 30s. So it's undeniable that we are still steepening, and that is the central tendency. We've been lucky to catch it from quite a way back, and we know what that means. But I am absolutely not outright bearish is this 148.90 area, and I think the reaction higher from that level is going to be quite strong. But as you can see, we are just basically faffing around. We've done nothing for 1, 2, 3, 4, 5, 6, 7 weeks, and you could even say that we've done nothing for the past 10 weeks. So it's very hard to get any kind of direction from bonds. All they're saying is that there's a slight steepening tendency. Yields are very, very, very slowly backing up a little bit, but they are contained, and as long as the yield curve doesn't, in the 530s, doesn't go through 140, that will indicate that that trend is continuing, and that is actually one of the features of risk on. People selling their longer term bonds in order to buy equities because they see the return continuing to be stronger in equities. And I can't argue with that. I think that is very much the trend. You buy the dip in the equities because equities are the strongest market, followed by gold, followed by bonds. And as long as the dollar is as weak as it is, with a continued weakness and as a trend, I don't think the equity markets can do anything but do better, certainly relative to other asset classes. My target here is still the same, around 88.44, and the trend is intensifying. Every time, we got to 91.01, poof, straight back down on the weeklies. Do I exclude the possibility of a retest of around the 92 area? No, I don't. But I think it's going to get sold, and it's going to get sold heavy. And that is a buy the dip environment in equities. I don't think the S&Ps are going to top out until the dollar bottoms out. And I think that has got quite some way to go and quite some time to go. So both in price and in time, we're likely to see lower prices in the dollar, and that gives me quite a bit of confidence that we have not seen the top in the risk markets. I think we will see the S&Ps spike higher at some stage during the first quarter of 2020, and probably by around 10%, or maybe slightly less, which gives us around that 4,000 level in the SPOs. I really don't think we might fall just short of it, but I think that is the general direction of travel. I mean, you can see at the beginning of the year when we had this spike, ever since we've been doing nothing but going down, and that coincides with the bottom of the SPOs, and this will probably coincide with the top of the SPOs when we finally hit the bottom in the Dixie. Is that anywhere close? Well, it could be close, but not in time, and probably closer in price than in time. It's going to take quite a bit of time to turn the super tanker around. This environment in bonds and in the dollar is exactly what is for gold. It's a buy the dip environment as well. There is no reason not to, although it is definitely showing signs of turning over. It's hugging the 200-day moving average, and that is not good. I mean, it's not bad, but it's not brilliant. I think my analysis has been spot on. You buy the dip down to 1765 and around 1850 to 1910, you are out of it. I see no reason for this not to continue for quite some time, and for volatility in gold to be very low, realized volatility to be very low, simply because the derivatives, i.e. the dollar and the bond market, are pulling in slightly different directions. but they're both very contained, especially the bonds, and therefore real yields are not changing very much. The dollar is giving it a bit of a tailwind, so you buy the dips down to 1810 and below, and you sell it when it gets around 1900. I don't think that's going to change for quite some time. I would be surprised if in the first quarter of 2020 we see it much higher than 1960. We basically do a prolonged period of trading and consolidating before we can even attempt some sort of a breakout to the upside. And equities are doing absolutely nothing wrong. That little panic that we had was funny. But here we go. We keep on touching this 36.45 level on a weekly basis and bouncing straight off it. While that persists and we don't close below 36.45, we are at some stage going to spike these top Bollinger Bands, and that is at the moment around, well, next week it'll be 37.80 or something like that. So there is absolutely no reason to expect anything but a move higher eventually. On the dailies, we're just as boring as hell. We're doing nothing, but we're holding the moving averages, and all the moving averages are in position to give us one last spike higher. On the 195 minute, I mean, it's doing absolutely nothing wrong. You cannot fault it. It's holding exactly where it should. The bottom of the Bollingers goes straight back up. It gets every dip attempt is caught by the moving averages, and I have no doubt that at some stage before the end of the year or into next year, we trade up here at the top of the Bollinger Bands around the 37.40 level in the INX. Absolutely no doubt. The basis is what, 10, so I would have thought that by the end of the year we'll have traded 37.25 in the ES futures. It's doing nothing wrong. Why try to fight it? Well, VIX is definitely more skittish than equities, isn't it? What a beautiful spike up we had to get out of that trade. I think this will continue. I think VIX will continue to remain relatively bid to equities. I see the possibility of VIX falling below the 17 level as very slight. It's interesting how it just keeps on making higher lows. But that to me is more of a signal that people are very reticent, or the professional sellers of volatility are just not around. And that gives us some very good trading opportunities and will continue to give us very good trading opportunities. I don't think that the higher levels of VIX are a sign of an impending disaster in equities. In fact, I think it's the opposite. I think it gives us some wonderful opportunities to sell in the money puts on a big dip and catch both the volatility component and the price appreciation every time there's a rally. It's going to continue to give us some wonderful trading opportunities, and really I think trading volatility against equities is going to be one of the most profitable trades of 2020. If we look at the relative performances, ITOT.gov is still very much trending upwards. Let's have a look on a daily basis. It's just, there are very few slight pullbacks, but the moving averages are beginning to follow it, and the trend is very much set. I see absolutely no reason to not buy any dip down towards 2. That is going to, this is not the top. This is not how tops are made. You want to see a very good spike before you want to get out of equities relative to bonds. And even if we have a look at all the other relative markets like EWG to EWJ, i.e. Germany against Japan. Germany is still in a big downtrend against Japan. That's why I still prefer the Nikkei. And if we look at SPY over FEZ, i.e. The S&Ps against Europe, I mean, the trend is unmistakable. You want to buy the States and Japan against everything else on dips. It's just as simple as that. There is really not much more to be said for it than that. The two strongest markets are Japan and the States. Every time there's a dip, I am a buyer of both. This chart probably gives you the best representation of what happened this year. We have gold, we have the S&Ps, we have TLT, we have EM, we have EWJ, which is Japan, EWG, which is Germany, FEZ, which is basically the stocks, and then we have DBC, which is commodities, all from the start of the year, basically 24th December to 24th December 2020. And we start with a normal, 1-2% in January. Everybody's happy. Then boom, we get the coronavirus panic into February and early part of March. And since the middle of March, when basically all equities bottomed, and as you can see, TLT topped out. TLT has basically gone sideways. I mean, absolutely sideways. And while equities have caught up, naturally, the best performer in equities was SPY, followed by EM, followed by EWJ, followed by Germany, followed by Europe. So that is very much, but then the deviation between the equity markets is not that huge. It's sizable, 10% deviation between the top, i.e. the S&Ps and the bottom, FEZ, is quite a sizable deviation, but that is what you would expect. You would expect the leader to be the States, because they have done so much in terms of QE, and also the dollar is depreciating, but although this is in dollar terms, so the dollar is really not part of the equation. But it's natural for people to buy the S&Ps, and there are no surprises here. And also the performance of gold at 25% for the year is quite damn good, and that is why I think it's going to go sideways for quite some time, simply because I think the equities are going to catch it up. If we have a look at a much longer term chart, this is 20 years, you can see that basically SPY and gold are keeping pace, and TLT, there is not that much of a difference between their performance over the past 20 years. The laggards, FEZ, Germany and Japan, I think Japan definitely starts catching up next year. I think it has a lot of room. The EM chart is a little bit, doesn't tell the true story, because it came along much later and we had this huge spike. But basically we've done nothing for the past 10 years or so in terms of performance. So I would have thought that the next year we're definitely looking for more out of Japan than many other countries. But if we go back to the 1 year performance, or the year to date, let's have a look. I would have thought that definitely gold and TLT over the early part of next year are going to be the most boring markets, while these equity markets surpass them on the upside. I still think there are at least low double digits, if not low single digits, if not low double digits in performance for the first part of the year in equities. What happens after that is going to be very interesting, because I think that actually once we've achieved that performance from the equities, the rest of the year is going to be very volatile, and probably we're going to close it somewhere very close to where we closed the first quarter. I think the last 3 quarters are going to be very volatile, but probably the net result is going to be zero. We will attain probably most of the returns that we're going to make for the year by March. Well, basically the spread between SPY and TLT gives you a resume of 2020 and gives you an indication of what to expect for the first quarter of 2021. And now I'm going, sort of really out on a limb by saying what I think is going to happen in the latter 3 quarters of 2021. But basically the story was everything was going fine. Thank you very much. We're going higher. Oops. Coronavirus. No, I don't believe it. Yes, my God, panic. And then this was the point where basically everybody started discounting the reopening of the economy. And you can go back and have a look at all my videos. I kept on saying the market is going to discount something like 22 times earning, because bond yields are so low, and the earnings are going to be around $160, sort of in cumulative earnings. So what did that give you? That gave you around 3,500, and then people started going and, well, no, earnings aren't going to be 160, they're going to be 170, and now they're going to say, oh, they're not going to be 170, they're going to be 175. But you can see that trend. That basically is very small incremental increases. And what is that going to do? That's going to give us a target of around, 4,000. And this chart is going to go up and take out these highs, and then we are set up for disappointment. Because let's face it, real growth is pathetic and will remain pathetic. I can't imagine that a Biden presidency is going to bring us any revolution in, cutting regulation or anything. Basically the guy is half dead and he's waiting for death, and he's going to be steady as you go. So we will set ourselves up for disappointment, because we will have discounted everything that there is to discount far too early, and then any event is going to, and there will be events that we can be sure about, is going to bring us straight back down to this line, if not down to these moving averages. And then we recover, because, sort of things always do, and then we come back to exactly where we were. So I think that is why I think the returns for 2021 are going to be concentrated in the first quarter. That is where we still have the possibility of better than expected surprises, and discounting some more. Let's discount some more and more and more. And then after that, I think the odds are that the only trade left is one of long volatility, long markets, because when the dip occurs, that will be the wonderful opportunity to get out of volatility, because volatility will have gone up far more than the markets will have come down. Basically, that is, in a nutshell, what I expect. I see no reason now to get out of risk spreads. I think we have at least the first quarter still of very strong returns for risk. After that, I'm far less bullish. Well, thank you very much indeed for being with me this whole year, and let's hope you have a very Happy New Year and a very profitable 2021 together. Finally, before I leave you, the summary sheet, I've changed very, very little. The only trade that interests me here is SPY WM 182.27 is where I think we start doing something and averaging it down to around 178. That's a 2% range to 2.5%. I think we get there. And that will be the most interesting. There's absolutely no reason to think that SPX is going to go down unless it breaks 36.44 on a daily closing basis. And I see the probability of that being very low. Everything else is steady as we go. There are absolutely very few changes. Any kind of rally in DXY as we got to 91 last week is a big time sell. Thank you very much indeed. Tweet you on Monday, and let's have a very prosperous 2021.